estate agent, you work hard for every single commission check. But if you're not being smart with your taxes, you could be giving a big chunk of it away unnecessarily. The truth is, whether you're a brand new agent doing a few deals a year or a top producer running a full team, there are real legal ways to save money on your taxes. Today, I'm going to share the top tax saving strategies that realtors actually use, what you can implement right now, and examples that show how these savings play out at different income levels. Hey, it's Mark here with the Hiller Group, brokered by eXp Realty. My team and I have you covered here on the beautiful Florida Panhandle from Pensacola all the way through Panama City, where our team has been fortunate enough to help over 1,600 clients and sell over $500 million in real estate in the past 12 years alone. Quick note, I am not a CPA. I'm just a realtor trying to save on my taxes. Always verify with a licensed tax professional before applying any of these strategies. Most real estate agents are classified as independent contractors. That means the IRS views you as self-employed, not an employee. The benefit? You can write off ordinary and necessary business expenses that help you earn income. The first step to saving on taxes is to act like a business. Open a separate business bank account. Use a business credit card. Keep clean books using QuickBooks or even an Excel spreadsheet. Track every expense related to your work, your mileage, your signs, your marketing, gas, a pen, even work in office snacks. It sounds simple, but this step alone often saves agents thousands because it makes deductions easy to claim and defend. Next, maximize your vehicle deductions. If you're showing homes, going to inspections, or previewing listings, your car is one of your biggest tools and one of your biggest deductions. You can choose between standard mileage deduction, multiply your business miles by the IRS rate, 67 cents per mile in 2024. Actual expenses, deduct gas, maintenance, insurance, repairs, depreciation, and car washes based on your business use percentage. For most agents, mileage tracking apps like MileIQ or Everlance make this automatic. Here's a pro tip. Keep a quick note for every trip. Showed 123 Banana Street or met lender for pre-approval consult. The IRS loves clear records. Up next, claim your home office deduction. If you regularly and exclusively use part of your home for work, you can qualify for the home office deduction. You got two options. The simplified method, which is $5 per square foot up to 300 square feet, or the actual expense method, a percentage of rent or mortgage interest, utilities, insurance, and repairs. Even if you sometimes meet clients elsewhere, your home office can still qualify as your main business location if that's where you go to do paperwork, make calls, or do your marketing. Do not overlook marketing and lead generation costs. Nearly everything you spend to grow your business is deductible. Online ads, Google, Facebook, Instagram, YouTube, website hosting, design and domain fees, editor software, flyers, postcard, open house signs, photography, video editing, social media content creation, paid promotions, and so much more. If it helps you find, nurture, or convert clients, it likely qualifies as a business expense. Marketing write-offs are one of the best tools you have because they both grow your income and reduce your taxes. Any classes, conference, coaching programs that helps you improve your real estate business can be deductible. For example, CE credits or license renewal fees, real estate boot camps or masterminds, coaching and mentorship programs, industry conventions like NAR, John Cheplack events, Tom Ferry, Inman, etc. Any event you go to. If the trip is primarily for business, you can often deduct travel, lodging, and half your meals. Don't forget professional fees and insurance. You can deduct Realtor Association and MLS dues, broker desk or technology fees, E&O insurance, legal or accounting services, CRM subscriptions or transaction management software, system software. These are straightforward write-offs, but they are easy to miss if you're not reviewing your expenses quarterly. Next up, you want to pay yourself smartly with the right business structure. If your income is growing, you may benefit from forming an LLC or an S-Corp. An LLC protects your personal assets, but an S-Corp can help you reduce self-employment tax. With an S-Corp, you pay yourself a reasonable salary and take the rest as distributions, potentially saving thousands in Social Security and Medicare taxes. This is a conversation to have with your CPA once you're consistently netting over $60,000 to $80,000 annually. You also want to contribute to a retirement account. You can dramatically reduce your taxable income by contributing to a retirement plan. Options include a SEP IRA up to 25% of your net earnings, a solo 401k, higher limits plus Roth options, a traditional IRA. A $10,000 contribution can easily save $2,000 to $3,000 in taxes depending on your bracket, and it grows for your future. Explore depreciation and real estate investments. If you own rental property, depreciation is one of the most powerful deductions available. You can write off a portion of the property's value each year as it wears down, even though you're likely gaining value long term. Advanced investors also use cost segregation studies to accelerate depreciation, allowing bigger tax deductions in the early years of ownership. This is more relevant for high producers or those who also invest, but it's a game changer for long-term wealth building. Many agents will qualify for QBI, the Qualified Business Income Deduction, which allows you to deduct up to 20% of your business income. Not everyone qualifies. It depends on your filing status and your income level, but it's worth asking your accountant about. This one provision alone can make a 5-figure difference for top producers. Let's check out real-life scenarios, low versus high producer. Low producer example, income level of $60,000. Let's say the expenses are $15,000 for marketing, mileage, and all the dues. You have a retirement contribution of $5,000 into a SEP IRA. Your taxable income could drop from $60,000 to about $40,000. And after accounting for half of your self-employment tax and QBI deductions, you might only pay tax on roughly $32,000. That is a major reduction. Now let's look at a high producer maybe making $500,000. Let's say your expenses are $120,000 for staff, ads, software, cars. You have an S-Corp structure and a 401k. Let's say you have a $60,000 contribution there, right? Depreciation on owned property is at $25,000. Your taxable income might shrink to around $275,000, saving tens of thousands of dollars in taxes while reinvesting in your business. Common tax mistakes that agents make are mixing business and personal spending in one account. Forgetting mileage or small write-offs, they all add up. Make sure you're making quarterly tax payments, especially if you're over the $100,000 mark. Waiting until next tax time to organize receipts will cause massive overwhelm and can get you in trouble. Not revisiting your entity structure as you go. A few hours of organization each month can save you headaches and thousands at the year's end. Tax savings aren't just for top producers. They're for every agent who treats their career like a business. The more intentional you are with tracking, planning, and consulting professionals, the more money you keep in your pocket. Start small. Track your mileage, set up a business account, talk to a CPA about what structure fits your income, and remember, the money you save on taxes is money you can reinvest into growing your business or your life. Hope you found this video helpful. If you need a great CPA recommendation, send me a private message. Hit the like and subscribe button, and we'll see you on the next one.